Hi, I'm Vignesh Sivakumar from the Phoenix Financial Training CFA Simplified team. Today we're going to talk about a very simple topic from corporate finance, the concept of leverage. Now, what is leverage? It is a measure of how much of fixed cost a company has. As you will appreciate, a higher share of fixed cost, whether it be in the form of operating expenses like rent, salaries you pay, or whether it be in the form of interest cost that a company incurs purely because it has debt, is effectively a burden for the company. Purely because any reduction in revenues will have a reduction or will result in a reduction in the variable cost, but not result in any decrease in the fixed cost, which effectively means a small fall in the revenues, assuming the fixed costs are really high, will result in a massive impact on your earnings. Now, when we talk of leverage, as we've just mentioned, leverage is a measure, an indicator, shows the extent of risk within a company. Leverage can broadly be looked at from two perspectives. One measure of leverage is what we call degrees of operating leverage, which measures the extent to which the organization's profits are affected due to fixed operating costs. And what would fixed operating costs be? Things like rentals that you pay for operating your factory. And how would you calculate the degrees of operating leverage? There are two formulas, two things that you can use to compute, two ways you can compute the degrees of operating leverage. The first way, percentage change in your earnings before interest and tax, which is nothing but your operating profit divided by the percentage change in sales. Alternatively, if you didn't have information in the question on percentage changes, if you just had let's say information on sales and revenues and prices and variable costs given to you, another formula you could use to calculate degrees of operating leverage is to take the contribution and divide it by the profit. Now, when I say contribution, in this context, it refers to your sales revenue minus your variable cost. Profit, on the other hand, just to be absolutely clear, represents your earnings before interest and tax, which we also call operating profit. Another measure of leverage is what we call degrees of financial leverage, DFL, which measures the change in your underlying earnings, the net income, compared to the percentage change in your operating profit. You could alternatively calculate this as your EBIT, which is the operating profit, divided by the EBT, which is the operating profit less interest. Now, we'll try and have a look at a quick example to try and put these formulas into practice. Let me just quickly go through this question. Croft Inc. sells 5,000 units at a selling price of 5 per unit, and the variable cost is $2 per unit. Fixed operating expenses are 5,000, the interest or finance cost is 2,000. We are asked to estimate the DOL and the DFL for this particular company. Now, how would you do that? Remember, you're not given information in the form of percentage change in earnings or revenue or profits. Hence, we must use the second version of the formula. So, let's try and use these two formulas, the contribution over your EBIT and the earnings before interest and tax over your EBT. Now, if we try and calculate the sales here, it comes out to 5,000 times 5, that's $25,000. The variable cost is 2 times 5,000, which is 10,000, which therefore means the earnings before interest and tax is $15,000. Let's knock off the fixed cost of 5,000, which therefore gives us the earnings before interest and tax of 10,000. By the way, that was the contribution there, less the fixed cost of 5,000 gives us earnings before interest and tax of 10,000. The only other item we need to probably knock off at this stage is the interest, and we get our earnings before tax as 8,000. Now, once we have these numbers, you know what to use. We need these three numbers, don't we? The contribution, the earnings before interest and tax, and the earnings before tax. And using that, the degrees of operating leverage, DOL, can be computed. Remember our formula there, contribution over the earnings before interest and tax, which would effectively be 15,000 over 10,000, 1.5. Yeah, and straight away, when you're doing an exam question, the answer is A, because that's the only option with DOL of 1.5. But we'll make sure we get our DFL number as well. The degrees of financial leverage would be your earnings before interest and tax of 10,000 divided by 8,000, which gives you 1.25. And therefore, you've confirmed A is the correct answer. Now, to summarize, the basic idea about DOL and DFL, higher the DOL, higher the DFL, it is indicative of higher risk inherent in the company.